Welcome everyone. How we doing? Nice. Yeah. Love that guy. Happy I brought him into VC and he decided to get back on OT with us. He's got a he's got a unique view on the market, that's for sure. I love it. Yeah, he's great. He's awesome. He's somebody that I do talk to a lot. Like I brought up before, we're friends, good friends, talked for years and uh we trade about as different as he possibly could, but it's we end up at the same place a lot. So that's always good, and I don't recommend too many people as being worth listening to, but he's definitely one of them. As far as actually trying to understand everything he does though, man, that's it's a long battle. Welcome everybody. We'll get a few more minutes, see if a couple more people want to show up. Greek's lectures go hit or miss. They're either packed or empty, so we'll see how this goes tonight. Armando, how we doing? Most excited trader out there. Love to see it. Yeah, well, and so we'll get into it a little bit more, but I always try to apply, you know, I want we're going to talk Greeks tonight, and what they are and blah blah blah. But we we really want to know how can we use that for trading. So after this, or after we kind of talk about what they are, and even while I'm talking about it, we'll be covering kind of how to apply it to uh some of those trading strategies that I do like to use. Just give me a couple of seconds here, and we'll get going here in just a second. Okay. Just getting my notes pulled up. So I try to, I try to always make sure I don't miss any of the important parts. Give me just one more second. Yeah, one more second. We will get to rolling. Okay, welcome everybody. Happy to have you here, Dirty River. Tonight we are talking about the option Greeks. I love to look at them. I'm not saying, I look at them a lot before any of my trades. Especially shorter term stuff. I care a lot more about, really getting the Greeks that I want. Longer term, you can be a little bit more liberal depending on, what your plan for the trade is. Sometimes it's worth it to buy a contract with less delta and more time. Uh, Other times it's definitely not. Short time frame stuff, your day trades, your scalps. You generally speaking really want the Greeks in your favor, because if the Greeks are in your favor, then you have a higher chance of making money, and you can really, not only know how much money you're going to make on a trade, know how much money you could potentially lose on a trade. You can know all of that before entering a trade if you just pay a little bit of attention to option Greeks. You know, they can be really boring, but like I said, I like to look at them, so I look at them for every trade, but it's not something that you need to become, extremely, knowledgeable on or anything like that. Just know the basics. And so that's what we're going to kind of cover tonight. And then as we're going through what the Greeks are, we'll be able to discuss how to apply them to trades and know how you can use them in your favor, and hopefully, not get blown out. This is going to be, we're going to kind of cover stuff you guys see me talk about it in trade floor and voice chat all the time, that, you just don't want to be in those way out of the money contracts for short time frame trades. And we're going to talk about why. And so if we start, with the Greeks, it's always, it's hard to know which ones to teach about, because the basic ones tell you how much you're going to make or lose if the stock goes up or down. The next most basic one tells you how much you're going to lose in a 24-hour period. And then the other ones, which we're going to do those ones first. We're going to do a couple of them first before we get into the more important ones. So like I said, you don't necessarily need to become, the Greek master or anything like that. You just need to know the basics, to know how much money you're going to make or lose. But we're going to start with the slightly more advanced ones, than the ones that you'll likely slightly, you're going to pay less attention to these ones, but it's always the best place to start. And so what I have here, for anybody who doesn't know, this is just the option chain. So it's the contracts that you want to look at. Obviously, left side calls, right side is going to be your puts. And then you got your bid, ask, your price. And then for me, I have all of these up here. And these are the Greeks that I like to watch. We're also going to be covering some things that, one of them is not a Greek, but it is directly affected by the Greeks. And then we're going to cover open interest and volume. We aren't going to talk about, so much about how to use them for your trades, but we're going to talk about how they can kind of, some of the issues that they can cause in relation to the Greeks, specifically things like low OI or low volume contracts, and you can get wide bid-ask spreads that can give you a bad fill that can kind of, mess with your return from your Greeks. So we're going to be covering a little bit of everything tonight, but still just trying to keep it overall very, very, basic, so that hopefully tomorrow, when you are looking to get into a trade, you can take a, because when I say I like to look at the Greeks, what I really mean by that is that I like to take a quick glance at the Greeks and give myself a very rough idea of what the trade could do for me. And this is how, I like to analyze my risk reward is by using the Greeks. So the first ones we're going to start with, as I said, I won't say less important, but the ones that people care less about other than certain times. And so the very first one is it's going to be Vega. And so you'll never hear, well, you will very rarely hear people talk about Vega unless it's maybe, me or Tilio or Assassin or, a FaZe. Some of the sell to open people, your FaZe and your Zoro and people like that. You might hear them talk about it, but most people are not going to discuss Vega. And what Vega tells you is how much will the value of your contract change if, and this is where we're going to bring in one non-Greek, but you always have to talk about it with the Greeks, implied volatility. So IV, when you hear people talk about, IV's juicing or IV's dumping, or you're going to get, IV crushed on earnings, that's the big one. That's the one time people might be talking about Vega is, so you have IV and you have Vega. And what Vega tells you is for every percentage change in IV, then how much money will you make or lose? So, we're looking at Apple tonight just because, it's not a same day contract, so we can kind of use it for some of our examples. And so if Apple's IV was to increase to 22%, you would gain $8. So this contract would go to 116 bucks. So it can be very, very beneficial if you are on the right side of IV going up. Of course, it's always going to be small, you might even hear me or Flips talk about it in voice chat. When we say things like, don't buy on the tops of don't buy calls on the tops of green candles, wait for some sort of pullback. That is because the IV will shift down very, very lightly as, the stock goes down. So you will get a better price if you buy calls while the stock is going down or puts while the stock is going up, because the IV is likely going to be dropping a little bit on the way down. So when you hear people talk about an IV shift, that's what we are discussing. And so Vega is the one that tells you how much your contract is going to change based on a 1 percentage point change. So relatively simple, not something that, as I discussed day to day, like intraday day trades, not a huge deal. You still don't want to be buying the tops of big old green candles or anything like that, but not super important there. But worth noting always. But when you start taking your ER trades where maybe you're going to have a shift of 100%, maybe this is, I always want to talk about this when we talk about these, when you use these, Greeks on earnings, that's when you can really, really see the most dramatic effect of the Vega IV relationship. And so, we can see this one. It's Apple. It's, its IV might increase or decrease by 1%. It's not going to be huge. However, when you're going into earnings, and sometimes, you'll see people buying contracts and they'll say, oh, it has, those contracts have 600 IV. And you have to think that's not normal. IV returns to normal. So what IV crush is, say you're buying $1,000 contract, it has 800 IV, it's got 1 or 2 Vega, and that thing drops, the IV drops 700%, you are losing $700 of value. That's what IV crush actually is. People try to, it's a very commonly used buzzword, especially around earnings trades. But most people don't actually understand what IV crush is. And so that's what it is. When the IV drops very, very quickly, you lose a ton of money. Oh, yeah, Tesla's got earnings this week. But so we're on the tricky side of Tesla earnings because we're up there 100%. This is going to keep going up. So that is where, when you hear people talk about playing the ER run up, mostly done the day of, and it is very high risk, obviously. You are trying to catch a positive shift in IV. And so, this is the, final part that I was going to say about it is, or not the final part, but one of the last things I was going to say about it is that IV can work in your favor. IV increasing while you are in the trade will help you. You will gain money. And what is an example of that? It's again going to be around those earnings trades or news trades, things like that, and people will say, the stock is going up, but my puts are gaining value. When you hear that kind of thing, that just means that there's a very dramatic IV shift in one direction going on. So you can make money doing that. However, it'll only do so much. If you're in calls and the stock is absolutely cratering, even if that IV is going up, it is not going to offset the loss. There's a finite amount where you can actually make money. But the ideal way, and you of course never know how it's going to work because you never know exactly what a trade is going to do. But where you can make IV work in your favor is when the stock is continuing to go in your favor into a news event. That's how, playing an IV run up will work for you. And so, let's see, we got a question. Oh yeah, Tesla, and then what causes IV crush when the stock goes up? So that was a so that was a different one with Nvidia because that was the side of it was going the wrong way. There, as I recall, there was a lot of people like long into it. I don't remember, long or short into it, and it was going the opposite way, and it was just not going in their favor. That was what the real issue was there, because it is just that balancing act of you can only gain so much value from IV, while it's going against you, no matter how high that IV is. And then the next day comes around and the IV goes way down. And so, that's how you get smoked on the other end. So that's Vega and IV, something to always take into account. And then unless you trade a stock all the time, you won't always know what its IV is. Tesla sits at pretty high IV. Tesla will consistently be up there at 70% or things like that. So, going into the day before earnings, I don't exactly remember what day it is, but going into that day before earnings, you will see this up here a few 100%, very likely, at least in my opinion. Okay, and so any more questions on the Vega IV? Again, it's one that, like I said, intraday stuff, it doesn't matter a lot. Obviously, you can sneak a slightly better fill, if you wait for little bits of pullbacks or bounces, depending what way you're trading to actually get into the trade, but not a huge one intraday, especially. Hey, Scrooge Jr., how we doing? Okay, and so the next one that we're going to talk about, it's the one that everybody. Is there a particular Vega IV that I shoot for on a 0 DTE? No, not for me, because they adjust rapidly. So, and there, of course, as with most Greeks, that perform like that, Delta's one, you will see the largest numbers of, all of them, your thetas, your gammas, your IVs, your Vegas, they're all going to be, generally speaking, the highest right at the money. So you're going to see that there. Delta's one where the number actually increases. We'll get into that a little bit later. But as far as Vega or IV, if I'm trading in a 0 DTE scalp sort of stuff, it's not something that is of huge concern to me. Obviously, I actually saw somebody mention it earlier on SPX. The IV is very high because it moves. And so those shifts can kind of affect you if you are trying to scalp something like that. But generally speaking, it's not going to give me, I'm not going to be super concerned with it. A time where IV can really hurt you intraday, and you might need to take note of it, is when something gets news. So when something gets, some midday news, let's say, Boeing gets, let's say Boeing gets some midday news and uh, you don't, so, and you want to get in the trade. And so you get in the trade and Boeing's flying. Well, once that's moving the IV up, the IV is spiking because of the news. Well, as the market digests the news and starts carrying less, the IV is going to start dropping and you're going to start losing value. So it might still be going in your direction, but as that IV comes down, you are going to start losing premium because of it. So that's really the only time I'm going to be paying attention to it for scalps is around those news situations. But as far as like something I like, it is hard because, you have Tesla that frequently sits at 70 plus IV, or you got Apple that frequently sits at 20% IV. So it really just comes up to you and what you like to trade and being aware of what the stock you are trading frequently has as far as that. Okay, so next one we're going to talk about, it's everybody's most hated one because it is it just is there, and its literal purpose is to remove value from your contract. And so what that is theta. You'll hear people talk about it all the time, and what it actually is it's time decay. And so it tells you how quickly and how much money is your contract going to lose in value over a 24-hour period. So we'll just use Tesla because we have it up. It sounds kind of advanced, not advanced at all. It's a very, very simple calculation. And it's something that isn't understood super, super well for how it works because, the stock price is always moving up. So theta is always moving up. There's actually another Greek that tells you how much up or down. We aren't talking that one. It'll move, but these Greeks are always moving. And so when you see that theta number, like on these Teslas right here, $154, what that is telling you is that over the next 24 hours, this contract is going to lose $154. So Tesla closed at 217.97. If Tesla opens at 217.97 tomorrow, then this contract is going to be worth $125 less. I guess I should put out this disclaimer. It is Tesla earnings week. If Tesla opened flat, this contract would not be worth this. But generally speaking, you will lose $154 of value from your contract price if we were to open completely flat. But what that's really telling you is every hour you're losing, well, quick math in my head, about $6 an hour, $7 an hour. So when you hear people say, oh, I'm getting theta burned, that might be true on a same day. Because if you pull up the SPY option chain, you'll notice the theta, well, these are all expired. The theta on these for a same day is always going to be the value of the contract, because if it's not in the money, then it will go to zero. And so on Tesla, maybe we'll go to Apple, so it'll be more realistic. So we got Apple, $36 theta. These contracts were trading at $107 going. That was the last traded price on them. So if we go into tomorrow, Apple opens at 235.86. These contracts are going to be down $33 just right off the open. Your contract's going to be at $74. No questions asked. And so that's what theta tells us. How much money is my contract going to lose? Well, how can we use this in our actual trading? And if you swing trade or you day trade high dollar contracts, because the higher the value, the higher the theta, and the closer you get to expiration, the higher the theta will be, because as I said, those contracts will be at zero at expiration, and they will only be worth $1 for every 1 cent they are in the money. So that's going to kind of lead us into our next part of people say when you're in the money, time decay isn't as bad. That is 100% false, because and this is actually an interesting thing. I get asked this question all the time. because Robinhood shows it. And so I don't trade on Robinhood, but on Robinhood, it says break even price when you enter a contract. So what does that mean? Well, it's telling you that if you buy, so say you buy these Apple 235s, if you buy these Apple 235s for $235, then you are going to need to be at $237.30 to have this contract to be worth $2 or $230. That's what theta, theta matters even in the money, even out of the money. It is telling you the value that your contract will lose in a 24-hour period. And if it doesn't matter if you're in the money. If you don't understand intrinsic value, we can get into that another time, but you only get paid for your intrinsic value, how much money you are in the money. So theta, it's hurting you in the money. It's hurting you real bad out of the money because you'll go to zero, but theta is always hurting you. And it is telling you that you will lose this much money over a 24-hour period. So how do we use this as traders? A day trader, if you're trading contracts, like those Tesla contracts that were $600 and have 150 theta or whatever they were, you need to be aware of that because your contract is going to be losing value all day. And because it is more expensive, your theta is going to be a higher number. And when you have a higher number, that means that you're losing more money off of each contract, more dollars off of each contract all day long. So how do we control that? Or how can we, make it, not necessarily work in our favor, but hurt less? And the answer is buy time. I'm not going to say that you shouldn't ever swing weeklies or anything like that. You typically shouldn't because you're fighting the Greeks, you're fighting theta, you're fighting all of those. But if you want to swing, you should almost always buy a little bit of time. I know a lot of people in here swing weeklies and you get to see some like nice gains, but the important thing to remember is that you will also see some nice losses if you do that. So we're going to get a little bit more into, we're going to get a little bit more into this as we get into the next Greek that we're going to discuss. But I just want to show you here on this Tesla or on this Apple contract, 33 theta, $100. That means if nothing happens in the next 24 hours, then you are losing, 33% of your contract value to just own it. So very high percentage. And then if you buy the next week's, you'll see, and much more dollar value. That's why when you hear people, me or Tilio or anybody that swing trades say, buy the safety, buy time, that you pay more for that. However, we get a look at this, and this contract is $400. If Apple does nothing in the next 24 hours, then the theta is only going to take $26. So, it's a much smaller theta the more time that you have. And don't get me wrong, it's a $400 contract. You're going to lose, you're going to lose $26. I don't know, that's 6%. So that's how you have to look at it. The weekly contract, you're losing 33% of the value just to own it. This one, you're losing 6% of the value just to own it. So that is what buying safety is. And then even as you go out further and further, the theta will get lower and lower because it increases exponentially the closer you get to expiration. And then I do want to point out one more thing, and this is just, this is a technical thing. It's always important to remember that, when you're trading and you're analyzing theta, this is a 24-hour period. So, the 12 hours between, market close and market open or, whatever, you can cut the theta in half, give or take, So this Apple contract at open tomorrow, going to lose approximately $16 into the open tomorrow. And so you always need to remember that when you're doing your calculations for potential losses, which can be exacerbated, of course, by the next Greek that we're going to talk about. But always remember, it's hour by hour. So tomorrow morning, you will get hit for all of the hours that the market was closed. So always, keep that in mind when you are thinking about theta, because that's going to come as just one hit right off the open. There's slicing value on your contract. So does everybody get it? I know pretty easy to understand. And but it's everybody's enemy as an option trader. And it's that main reason that we recommend buying time. Okay, we're all good there. So final one that we're going to talk about is delta. And delta is the one that I think you should pay attention to Vega and IB. I think you should pay attention to Theta because, it tells you some losses you might have to accrue. Delta is the one that, in my opinion, you should at the very, very least glance at it for every single trade because Delta tells you for every $1 the stock goes up or every $1 the stock goes down, how much money you will make or lose. So what do we mean by that? Well, and we're going to do it simplified and get more and more detailed. We're going to keep using these Apple contracts. Say, and Apple's at 235.86. We buy one of these, $107, and we get a $1 candle out of Apple, ignoring all of the other Greeks, but we get a $1 candle out of Apple. Well, you are going to go up, and we'll get into it in a second why it'll actually be a little bit more than this, but you are instantly going to be up $36. So your contract is going to be worth 140, whatever it is, $143. So how do we use this? How can this help us? How can it help us in all of our trade planning? And how do we apply it to the charts? And so that is what I always try to tell people to do. If you are taking a trade, you should, in my opinion, at least be analyzing the Greeks a little bit and understanding what you're doing. So we're going to use Apple as the example and say, why I always preach buying at the money. So the delta is going to be higher and higher and higher the closer in the money you get. And then as you get in the money, it will increase higher and higher and higher. Obviously, that's what delta does for you. What tells us how much it is going to increase? Gamma. Gamma tells us the exact same thing. If the stock goes up $1 or the stock goes down $1, how much will my delta change? So this is actually the most powerful part of options trading is catching those slightly out of the money to in the money shift. And why is that the most powerful part of option trading? And this is, sort of an advanced way to look at it, but what options provide us is additional leverage at no additional cost. And what do I mean by that? Well, if you buy these 237 or 237.50 calls on Apple and they got 36 delta, you are, for $100, I might add, you now have the equivalent of 36 shares of Apple. That's what delta is telling us. That's what delta is telling us. We have that benefit of 36 shares of Apple. It's also telling us, oddly enough, the percentage of the chance of it going in the money, but nobody thinks about that because it's always shifting and it's wildly inaccurate, And so we have 36 shares of Apple for $100. If the stock bounces $2 and we end up in the money, we now have the benefit of 58 shares. That's a big jump. And so, we now have, we've got 50% extra on our position, even a little bit more than 50% extra on our position, and it cost us nothing. So delta is the true amazing benefit to, trading options is delta increases the closer in the money you get. So you are receiving additional leverage at no additional cost to you. And gamma is what's telling us or how much we're going to gain on that. So you can see delta, the maximum number it can be is 100. Does it ever actually hit 100? I don't know. It's kind of more theoretical. Sometimes you'll see it pop up, but the highest you can get up here is these 94, 95, 96 deltas, And so that's telling you that you're up, you have the benefit of 96 shares or whatever it is of Apple for $1,800. So where's the rough side of this? Well, when it goes against you, of course. We have 36 shares of Apple, or, this gives us the benefit of 36 shares of Apple. If Apple moves up $1, we make $36. Well, if it goes against us, we drop. And since Apple moves in increments of 250, realistically, if we move one full strike out of the money, now all of a sudden we have 18 delta. We have much less delta available, and we need a larger move to get us back to break even. So that's why you might see, sometimes you buy something, say you buy a contract at $50, it goes against you a little bit, and then it comes back to the same price on the chart. You're feeling a little bit of delta removal, and you're feeling a little bit of theta because, and or it comes back to the same price on the chart, and your contract doesn't come back to the same value. That's what's going on. So it's always worth it to be, be very, very careful. Be aware of what your delta is, and then understand, what's required of the delta just to get you back to break even. And once you start doing this a little bit more, you'll probably start to have a lot easier time cutting, contracts that have gone against you, because you actually understand the math of what it takes to get back to where you were before. And so that's delta. So how do we use this? And what are some advantages to it? What are some things you can, some trades that you can take, or some ideas that how can we use it to know, trade planning and things that we might be looking for? So we're going to just use Apple today, and I'm actually going to pull up the Apple option chains right next to it, because Apple offered an entry this morning that that I missed. Let's see, give me just 1 second here. It gave us a trade this morning that I personally missed. So say we're looking at Apple and we're coming into today, we're coming into the day, we see us selling, we see us coming down to our big level, we're aware of the risk right here. If we're trying to buy calls, we're risking just shy of $1 total risk on this trade if we're trying to buy calls anywhere down here. Obviously, it's not always like that, but we can say coming into the open, I want to be a dip buyer on Apple. So the first thing that I'm going to do if I want to be a dip buyer on Apple is I'm going to pull up the option Greeks and see what they tell me, see what contract I want to be in, see where we're trading. So Apple is one that it trades in $2.50 increments. So when we're trading down here at 233.14, there isn't a 234 contract to trade. There's a 235 contract to trade. So unfortunately, well, I mean, not unfortunately, that's just the way it is on Apple. You have two choices. Go in the money, which is going to cost you a lot more. It's going to carry a decent amount of risk because your delta is going to be high, or go for that next strike out of the money. In my opinion, you should always be going for the next strike out of the money. So then we're going to send it, obviously you're going to send it to your active trader or however you trade, and you want to start analyzing this, and you want to start analyzing, you want to start looking at Apple. You want to start saying, okay, what kind of value can I make on this contract? And we know that at the time when we're buying it, it's sitting around 40 delta or so, that 35 delta range, something like that. And so our final target is going to be this 235.70. So, and there's a bunch of stuff in the way. There's obviously levels here. You guys know I just trade daily levels, so they're what I look at on my charts when I'm trading it. So we know that we likely want to be getting into these Apple contracts somewhere around this 233.14 level. It's not going to be the type of trade you bottom tick. You're going to want to see some candles holding above it. So we'll just say that you're going to get in them at $120. We know that our ultimate target is $2.40 overhead. So if we have our 35 delta and we times it by 2, and we have our 35 delta and then we're going to times it by 2.5, we know that we're looking at about a potential $100 return here. So we take our entry. Hopefully you're trimming on the, and we take our entry. Option contract shows us we're going to get around there, $120 or so. You should obviously be trimming this whole way up. And then ultimately, when we push to our level, $220. Wow, okay. I didn't think it was going to be quite that on, but $220. And we knew from our delta, we were going to make about $100 if we made it all the way to the target. We ultimately made it all the way to target, even a little bit above. And we knew that before we entered. Well, what's the other side of it? we want to know our risk. Maybe our stop is, a close of this low a day, or maybe our stop is this 232.34. So if we're entering at $120, we know that we have 35 delta, then we know that we have about 35 bucks at risk. And if we do end up getting stopped out below this level, our contracts are going to go from 120 to $85. And so that's the risk we have on the trade. So we now know our risk reward. We know how much to the nice little ballpark we could lose, how much we could potentially gain. And we know that before we enter the trade. We have all of our risk reward laid out. We know all of that. And so that to me is one of the most powerful aspects of Delta is you know what the trade is going to pay you or how much you're going to lose before you are in the trade. You can analyze all of that. It obviously gets much more difficult with same days where they're going to zero at the end of the day. But if you're a day trader and you trade your Apples, Amazons, AMDs, I mean, even Nvidia, Tesla, the volatile names, you can figure all of this out on really any trade. And so that is why I always recommend trading these at the money contracts because the math is very easy for you. There are days where, a big old face ripper happens. And what does that do on an out of the money contract? And so tonight, I normally don't talk about these, but I wanted to show you the differences in them. And so, as we discussed, the Apple only has the 250 strikes, and obviously all the charts are going to look somewhat similar. But we have to analyze the Greeks. And so we buy these contracts here, and we knew that our risk was about $35. And I don't know how many percent that is. But I don't know, it's probably 25%, 30% off the top of my head. And so 25 to 30% loss on this contract. Well, and that's the 235s. The next strikeout is the 237.50. We know from just glancing at the option chain that they're going to be around, $20. The delta is going to be right around 22 or, 22 bucks. So again, we would be looking for, around our same entry. I mean, we'll call it $50, 48 bucks, we'll call it. And we know that if we lose $1, we know from our delta that we're going to lose 22 bucks of our $48. So we're going to be down 45% on this contract. And that's too big of a loss percentage wise, especially because, if you're trading, you really need to be keeping your position sizes similar. So you would have bought 3 of these contracts, for the same price, right around for the same price, as buying one of the at the money ones. So where's the benefit? Why would you ever do this? What are some things about this? Well, you now know that the risk is much higher. Percentage wise, gain and loss will be much, much larger when you are out of the money versus, at the money or in the money. The percentage loss is always going to be much, much larger on an out of money. However, the dollar amount also going to be smaller, but you have to go, dollar for dollar if you're trading. Well, the dollar amount on an at the money is always going to be higher, and the percentage loss is always going to be smaller. So this is actually a pretty good contract to show it. We know on the other ones, we would have lost 25, 30%. We know on these ones, we would have lost 40, 50%, likely pushing 50% due to the other Greeks we talked about. So then what did it do on the upside? Well, we can see that it did, almost, 150%. Yeah, give or take 150%. So percentage return much larger, but risk was doubled. So give or take doubled. So the percentage gain that you make, your risk is doubled, your percentage gain is doubled. That's why I don't trade like that. I like to trade minimal risk and try to make as much as you can with as small as you can. You can see here, even until Apple really got to moving and pushing up, its delta was so low that as Apple rips, a buck 50, you make a nice 50%. Don't get me wrong, give or take a nice 50%. But Apple had to put in this awesome move to make that. Your at the money one is paying you a lot of dollars really, really quickly. And so that's the issue with out of the money contracts. They carry, generally speaking, double, if not more, of the risk. And so we should, as traders, have our number one goal be to reduce risk. And by analyzing delta, by analyzing all of these things, you can really work on reducing that risk. Yeah, exactly. 18 delta, 6 gamma, those kinds of things. And we can pull up the Apple chain again. 18 delta, 6 gamma, risky. And you can even, that's, where this issue arises. And I actually see another question in here. Simba is so everything in options is based off the stock price. Do not listen to somebody if they tell you options move the market. The stock moves the value of the option. We hear, the people in VC yelling like, oh, people are selling all their Tesla calls, the stock is going down. No, people are selling the Tesla calls because you don't want to be in calls when the stock is going down. That's what's going on, And don't get me wrong, there's of course times where, gigantic option order comes in that does affect the market, but that's affecting the market. It's, still the Greeks and the option value only move because of the stock price exclusively. But so where's the issues in these, So your delta drops, your gamma drops you $6. Well, now you got 12 delta and you're gonna add it back on the way up. But when you're down your 50% or whatever it is, from your stop out, you have to remember your contract is now minus 50%. For you to get break even, that contract needs to go up 100%. It needs to double in value for you to get to break even. And your delta has been reduced. So the stock needs to move up higher than your entry to get to break even. And whereas, if you are at the money and close to the money, man, even if it goes against you, you still aren't that far out. But if you start out of the money and you get way further out of the money, you have a very, very hard time coming back from it. There we go, Doodle. You like how I tagged you guys? If the contract is down 50%, does that mean it's lost half of its delta? Not necessarily. So these strikes right here are a little confusing because, as I said, it skips one. So if you go to something like, that's a bad one. Okay, look at all the things I trade. So if you go to something like KO that has individual strikes, well, I mean, these ones are big, unfortunately. That's just because they're weeklies. If you ignore my position, if you go to something like this, you'll see that it's generally not going to be half of it on a one strike move. But on those other ones where you're seeing basically a $2 move, then you are seeing a relatively, you're going to see 50% loss, Ramsey, you're late. Yeah, you like that needle. So your gamma. The interesting thing about all of these option Greeks is that they can all help and hurt you in a great way. And theta is one that it can be hard to find it helping you unless you're selling to open. But these can all really, really, really work in your favor. If you're moving deeper in the money, delta's working for you, gamma is working for you. If you're moving deeper in the money and news is flying you and the IV is juicing and Vegas helping you out there, then you're in that perfect storm of making money on an option contract. And so I recommend you learn them, like you learn your Greeks. Like I said, you don't have to really nerd out on them. I understand they can be boring for a lot of people, but learn your Greeks and it will dramatically improve your trading. Because I talk about it all the time. Trading's easy. Trading psychology is really hard. And people have such a tough job just, stopping out of trades, like when a trade is going against you at a certain point, you have to call it quits. And the Greeks can be that additional thing where you say, God, I bought spy calls here. My Greeks have been destroyed. My delta's way down. My contract's down 40%. I need spy $1 above where I bought it just to see break even. It will help you just make that decision and say, man, I need to cut these losses and just move on. So any questions on those? Any questions on the Greeks? If not, yeah, I've been trying to, I always try to leave 10 or so minutes so we can have questions at the end, look at charts, whatever you all want to do. Talk about what we think's going on in the market, all that stuff. So any questions? Let's get to them. Is it recorded? Yep, Noodle, gotcha. Yeah, Ninja is Noodle's best friends, they're roommates. Yeah, we'll check those, we'll check them out. Oh, that's that one. That's that like what's in a pro what's that KO position? Let's not talk about the KO position, okay? It's my small port, so we're good. I always do these lectures on my small port, and when I stream and like voice chat, I always do that on my small port because I've accidentally shared my account number a few too many times. So I finally just started a new account that if I share it, like whatever, steal the YOLO account. Oh yeah, we'll check out the stocks here. Give me 1 second. Appropriate percent of port size on a SPY SPX contract. That is just a way too open-ended of a question. But actually I can answer half of it. The appropriate percentage of your port size on an SPX contract is 0. I mean, I could get into it. I normally give my explanations of what, I typically do the SPY SPX correlation of why people are dumb to be trading SPX because you can, generally speaking, make the exact same amount, if not more money, trading SPY. And you don't have to be trading it like a total degen to do it. And so, that's normally what I do. But tonight I decided to branch out and show you guys some other stocks, But study the Greeks. Greeks is this excellent example of people who trade SPX don't understand Greeks. Like I'm telling you right now, if they did, they would trade SPY. All the rich people do, but retail traders who trade SPX don't understand Greeks. But if they're in, OOT, feel free to recommend this lecture to them so they can learn a thing or two. But then as far as percent of port size, it depends. If you have a large port, it can be a very small percentage. If you have a smaller port, sometimes it unfortunately has to be a slightly higher percentage, I mean, like I'm not going to say it's right, but if you have a $500 portfolio and you're trying to trade SPY and not be a total like sketchball and trade the out of the monies, hoping for like a nice windfall trade, you're probably going to be in it 80, $90 on a contract. So on your $500 port, you can start pushing a larger percentage by having to buy that safety. But generally, use as little money as you possibly can to make as much money as you possibly can. And then so KO, we're long on KO. You guys will know if I'm happy or sad come earnings before market open tomorrow. But then also I do I trade SPX on occasion, whatever, that's fine. If you know what you're doing and you aren't like thinking you're gonna retire from it, you're all good to go. Oh, Wheezy Man beats me. I don't know, nothing insane, I'm conservative, man. I just treat this shit like a job. I'm not trying to get, I'm not trying to be some super rich guy off trading or nothing like that. I love that I can like sit on my computer for a few hours a day and make myself a decent enough income to live. Okay, let's check these things out. Aqua Man or whatever that is. That's how I've been saying it. I don't even know how you say it. It's the hype train right now because I think it's even got like Sam Altman as the owner or something like that. I don't know, man. Is that his name? I think that's his name. Um, uh, you know, you can't play this thing when it's making moves like this. There's not much TA you can do on it. You can obviously take note of these major highs and like you can see like obviously that's where we're gonna bounce, and that's where the market is agreeing on it. But like I mean, look at this thing. It off of highs, just for fun. Let's see what it did here, you know. So off of highs, we had a nice 18% drop, followed by a 16.5% bounce. There's not much you can figure out from that, you know, at least in my opinion on this. But stays above highs, you can be cautiously long, you know, but when sometimes moves like this are met with moves like this, so just be careful, you know. What I think of Microsoft today, that it did exactly what it was supposed to do. Look at this. This was this was like, and TS will probably adjust it, but so my trend for 1791, and you know, see it adjusted up, but you know, that was like about as close as you can get to a trend break open absolute face ripper. And just like that, Microsoft has made itself known again. I think this 427, the next super crucial thing to watch. I was charting it up today for a buddy. 427, next crucial thing to watch. But these are all, you know, same levels and everything that have been around forever. I think, you know, Microsoft's just been, you know, it's been a hated trade for a little bit, and it came out swinging today for sure. But that 427.70 is where I'd be basing it around. But man, I'd be scared to jump in front of this thing short. I know it's been for a few weeks, it's been that easy. You know, I mean, for a while, it's been a relatively easy short, but and hasn't been able to hold gains. But this one's a little different. That's a monster. Think AMD will pass push one or push past 160. I mean, this is another one. It was funny because I was all bummed that I missed this trend break because I've been like waiting for it, you know, since July. And I missed this trend break retest on it. And then it sold back down. I was like, oh, nice. I think I made like a buck or two on a scalp here. And now it's just riding it. We'll see, what day is it? The 29th. So next week. Uh, I don't know. I mean, as long as it stays above this trend, you can try to scalp it long, but I do hate a trend break that comes back down and then rides the trend down. You know, it sucks getting stuck in that. I mean, yeah, and that's like I don't know enough about this company, but like when I see this, I'm not a buyer, you know? I mean, I'm not a buyer when I see that. Any partners on how to kick the mentality of holding losers too long and not holding winners long enough. Well, so the the best advice I can give, so check this out. We're gonna go to Apple because it was a trade that, again, I said I didn't take it, but it gave us an obvious one. So say we're looking at Apple, okay? Um, we know our entry is whatever, our entry's somewhere around here. Well, that's great. You know, our entry somewhere around here. This is our stop out. You know, I don't know what we're saying, whatever, 15-minute close under that level. That's our stop. So we know that. That's our mental stop. We don't want to put a hard stop here because, you know, we might, you know, it might wick down to there and it might bounce. And so that's, you know, where you can get stopped out, you know, and people will set stops wrong. They'll set them right at their point where they, you know, your stop should be set where you think it's going to bounce. If, you know, if you enter here, you better think it's going to bounce here. You know, you need to have that additional support below you. Or if you're going to short it up here, you better think the worst case scenario, it's going to reject up here, you know, either way. But this is your mental stop. Well, I personally always run what I refer to as a protective stop. And what's a protective stop? Well, we had these Apple contracts, we discussed them, you know, 35 buck risk or whatever it was. I think that's what it was. Well, you need to have a number in your head on every trade where, regardless of what the chart is telling you, you're taking the stop. So maybe you say, I'm willing to lose $50 on this contract no matter what, you know, that's it. Like if it hits that, I'm out. That's your hard stop. You set it and you do not change it and you do not remove it. You have to trade with some form of protective stop. So on the other side of it, how do you hold them longer? Well, I have a couple rules and I have a couple things that I like to, you know, use depending on the type of trading I'm doing. Obviously, if it's a scalp, I'm taking most of my position off quickly. However, this Apple trade, how would I have managed it today? Say I buy calls here and you know, I got my mental stop here and I enter these calls, protective stop is on. It's right there. It doesn't change. Stop losses only do one thing. They move up. A stop loss should never move down and a stop loss should never be canceled. So you enter this trade. Well, how I like to manage a trade like this, that, you know, I am looking for a bigger move. It's a day trade that could turn into a swing, those kinds of things. I'm typically going to get off of the 5-minute chart, hop on the 15-minute chart, and I'm going to, you know, I take my entry here and we get a breakout. Well, you know, we push to the top of the opening range. So obviously we take a trim. I know this is harder if you only have one contract, but you know, typically you take a trim, but maybe you only have one contract. Well, when you take a trim, what I tell people is if you were happy enough to trim, you were happy with the profits. So this is when your stop moves, and your stop moves to break even. Once you've taken your first trim, your stop goes slightly above break even. Well, now I use price action to tell me what to do. If we get a big breakout candle like this one, you know, we get a breakout, we get a pullback. Now we've trimmed. So that was our first breakout candle. We move our stop. You get another breakout, you pull your stop up to here, the bottom of the breakout. You get some more consolidation and another breakout, you slap your stop up to here. Because you know if the breakouts are failing, the trend is likely going to reverse. So you get another breakout, or you get this breakout, you move your stop up, you're still in there. You get another breakout, and this, you know, it's not always going to be this easy. Apple's just a nice one today. You get another breakout, you bump your stop up. You get another breakout, and at this point, you're like printing. So you start ratcheting those stops up, you know, but you get another breakout, then you move your stop up. And then eventually you're stopped at the end of the day, and you based your stops on the chart, and you just let the trades work. So you let the chart tell you what to do. You don't let your feelings tell you what to do. You don't let any of that get in the way. And you just say, you know, we broke out, I trimmed, we get a pullback and another breakout. I move my stop, we get a little, you know, consolidation. And these are 15-minute candles, you know, so it's great. Look at the 4-hour chop. Are you talking about Microsoft? Probably. I don't remember what we're talking about. Sold your calls too early on Apple or on Microsoft. Both were just face rippers today. Microsoft was insanity though. This was just nuts. Like, I mean, I know it's a 15-minute chart, but look at this one. Like, what a 30-minute candle on Microsoft. That is just insanity, you know? Probably not going to see an $8 candle on Microsoft again anytime soon. Yeah, don't let your feelings, just let the chart tell you what to do. You know, the chart's super, like, the greatest thing about the chart is like the thing don't lie, you know, like it just tells you the truth. It tells you what's going on. And that's how I trade everything, you know. I'm like, okay. And I didn't catch this trade. I was talking to my buddy about it, you know. You know, we broke out, we broke above the trend, we retested the trend. I buy calls, you know. Oh, you know, you push up, you trim, you're out of it, no questions, you know, no big deal. This is even, you know, and then this was when I tried to, hey guys, double top. For 1 second I was super scared, and then 2 candles later I was super happy. So that was a nice little one right there for sure. But just let the chart tell you what to do. Like, you know, oh, we're taking our first push down to VWAP and all EMAs in a trend line, and you know, we're wicking off of it, breaking back above a level. Maybe I should buy calls. You know, I mean, that's like, you just got to keep it simple. Get out of your own way and let the chart tell you what to do, and wow, your life becomes easy. Okay. If there's no more questions, thank you all for coming. Appreciate you for being here. A little option Greek talk, a little stock talk. Love it. So I appreciate y'all, and we'll figure it out. Oh man. Sorry, someone's sending me a DM. So I don't know why someone DM'd me this. Hourly 20 right here. And then this blue line is just the top of the opening range. And for sure, yeah, I mean, this was a very obviously break and retest entry right here that you could have taken. Yeah, thank you all so much. I appreciate y'all for being here, and have a great rest of your night, and we will catch you all tomorrow. Thank you.